Anyway, let's start. Well, first of all, thank you very much for those of you that are still here with us. We're going to go to our next panel. We're going to talk a very interesting subject that I think for a lot of corporations and a lot of organizations, this is going to be a really, really important discussion. We're going to talk about corporations and innovation. Something that some people might believe that this is an oxymoron, because a lot of corporations are not innovative or are really bad at innovation. But at least there are new ways and new solutions. And today we're going to talk about that. I will ask for you guys to introduce yourselves and let's get going.
Well, so the two of us are from a company called Liquid Labs. My name is Paul Jozefak. I've basically spent the majority of my career in the venture community. I started out as an entrepreneur, but that was a very short phase of my life. The rest of the time, I was mostly a VC. I had run SAP's venture group, which was a corporate venture fund here in Europe. Then I switched to a private fund based out of Hamburg, Germany called Neuhaus Partners. And before actually getting into venture capital, I spent some time in the legal field and in consulting. The path that I have taken in terms of my career steps is ultimately what led to Liquid Labs being formed, having seen both the corporate side and the private venture side, as well as the startup side of things. Working together with Michael, my kind of career path led ultimately to what we decided to create with Liquid Labs.
So, Michael Backes, I'm then tech, or originally a techie. Background was kind of, let's say, I did also an entrepreneur for a while, but I'd also been, let's say, inside large corporations. So I was in Nortel back when that existed, and had done, let's say, innovation kinds of things from a grassroots level. Moved across the ocean after I got out of the one company I started, and switched sides and went into venture capital, worked for a couple of different funds, eVenture, the last one, and that was then the connection, let's say the Auto Group, who is our like financier, if you want to call it that, and that's how kind of, let's say, ended up at Liquid Labs with Paul.
Right. By the way, I have notes here on my phone. It's not like I'm here checking my Facebook status, so just to let you know. All right, Liquid Labs. You know, what's the concept? What's the idea? Because I understand that what you guys are working on is on helping corporations deal with new innovative ways to develop new business models, to create new products, and we know that most corporations have problems with innovation because I have the impression that very often the corporations, one day they decide that they want to be innovative, and they just look for startups and they buy them, and then they try to build a successful acquisition just by buying a startup, and I think that's all they need. And a lot of companies are failing at that. What's the idea with your concept?
So what we really wanted to do was take a completely different approach to innovation. So we had actually sat down and said, how can we take what we've learned in the startup field, in the venture field, in corporate and private, and address the problem or the immediate need at most corporates, which is innovation now. And then we said, what's the problems that most corporations have when it comes to innovating? The biggest issue is not money, nor is it even finding people. It's usually the bureaucracy, the politics, kind of all these processes that are put in place, which just don't really work with startups. So we said, how can we do this differently? So what we wanted to do is take or create an entity which had all the benefits of a large corporation with all the benefits of a venture fund, combined as well with kind of the incubator startup approach. And what we also realized is that by being a separate entity, we could kind of sidestep a lot of the politics and all the bullshit that tends to take place inside a large corporation when you're kind of stuck in the reporting lines or the hierarchy of a company. So what we said is we want to be able to launch multiple projects without fear of failure. In most corporations, when you start something, a new project or whatever, you're always concerned about what's going to happen to me if this fails. Corporations aren't set up to fail. The whole startup world, though, and the venture community and the portfolio approach is dependent on, it's not dependent on failure, but it accepts failure. So it means starting potentially 10 companies and having maybe 1, 2, or 3 of those businesses be successful and just quickly shutting down the rest. So the way we set up Liquid Labs is to facilitate the quick initiation of projects or companies without any of the structure that a large corporation usually puts into place. We keep it kind of free flow. Everything's very, I guess, reactive as opposed to structured. And we have more than enough money. And we also have access to the corporate when we need to leverage assets of the corporate. And combining that all together with the teams that we put in place helps us basically be just as fast as if we were not in the corporate, and just as quasi successful as if we were in the corporate. I'll let Michael, though, add whatever I left out.
Well, I don't necessarily know if there was, let's say, too much left out of that. But the other thing that we do, which is maybe slightly different than, let's say, another initiative or something like that, another corporation, is we always set the bar at, we're going to create a company out of whatever this is. And that's important because, let's say, in a lot of regards, if you go and you start, let's say, a product or project or whatnot, and you, at the end of the day, create the piece of software and you hand that over, or, hey, this is great, and it has 1,000 features or whatnot, where does it go from there? And it's if we start with a company hypothesis and then let's say it falls short for some reason, but the product itself is really solid, can be used somewhere else, somebody else needs it as like a core feature or an expansion to the existing business line, at the end of the day, that's not really failure. If we set the bar only at, hey, we're going to create a software platform, and it doesn't quite then do anything at the end of the day, then it's a complete failure. So we set the bar, I would say, higher than most people by saying this thing has to feed itself.
Yeah. I have a question about failure. Okay.
And there's one more thing that kind of was very important for what we did, is we said also what's the problems that a lot of startups face, right? So we didn't just look at the corporate and say, how can we help corporates innovate? How can we also create something compelling for the startups, right? And one of the things that you have, and having both seen this kind of as VCs for years, is that especially in Europe, as startups, you have the problem convincing large organizations to work with you. In the US, it's much easier because these large corporates are actually quite used to working together with startups, and they don't really mind taking the risk, the product risk of a young company. But in Europe, in all the time that I was investing in startups, I realized how difficult it was for these startups to sell to large corporations, and it was almost impossible actually to land a deal with a large corporate that was ultimately favorable, right? You could get in the door and maybe get a test phase kind of in place and get some. It was basically a crappy deal. You might make 10 or 20K and basically give them 200 or 300K worth of value, but it's not really something that happens often that small businesses can work well with corporates. Further, one of the things that we also saw is that in Europe, even when it comes to the VCs, they tend to drip feed all the companies. So the financing rounds tend to be much smaller in Europe. And if you look at the way VCs behave, and they're actually their own worst enemy. Because they're so risk averse as VCs, which kind of is not what they do, but they still are. They tend to drip feed their investments, right? So they'll do a seed round of 10 or 20K or maybe 50K. Then they do rounds of like 200K, 500K, whereas the competitor in the US raises 5 million, 20 million, 100 million. And I don't really understand how VCs think European companies could ever compete when the competition is raising a factor of 100x at times of the same business in Europe. So what we also said is that working with a corporate in Liquid Labs, we're able to spend a lot more money up front to see whether something works. It's not that we're wasting money, but we just realize that you have to be very fast. And sometimes to be fast, you just have to have the money. And so that was one of the other things that we also said. We want to be able to be as quick as possible, potentially just as quick as a startup in the US, be it in the Valley or where else, to get something off the ground, to prove MVP.
I mean, there are a couple of points that I think are important to touch. And one thing is the element of failure. One of the problems with failure is that most corporations completely avoid failure. If you fail, you're out. And they are not really willing to take chances and take risks, which for startups, it's reality. You need to experiment, you need to try things. Some things work, something doesn't work, but you keep going. How do you deal with that? How do you deal with this, let's say, corporate mindset of hell no, there's no way that you're failing, to yes, we need to fail, but at the same time not glorified failure, because there is also this tendency in the startup world that failure is good, you're going to you fail fast, fail often. Failure is failure. but how do you connect this and you help both the startup and the corporation move forward?
I'm sure we both have an opinion on this. So I would say I completely agree. The whole concept of fail fast with the goal of failing is the stupidest thing in the world. Fail fast is a strategy. It's not an end game. So we see failure differently. We don't consider failure to be the goal of like fail 5 times so that the 6th time you can be successful. We actually, and this is just a story from our experience, we actually had something happen which we weren't expecting. So we said, look, we're going to do a portfolio approach. We'll start 10 companies, for example. We do 3 or 4 a year. But let's say we take the approach of 10 companies. And we're going to shut down businesses that don't work very fast. Not because we want to fail fast, but because we want to reallocate our resources. So we don't want to spend money, time, or people on businesses that just don't work. So what we want to do is we want to throw everything we have behind the businesses that are actually performing, and not waste time on things which aren't performing. One of the things that corporations tend to do very well is waste time and spend a long, long time shutting things down that don't work. I know everyone who's ever been in a large corporation, and I've heard this over and over and over, and I've probably said it more than I've heard it, is almost every large company, you could throw out 25% of the employees and nothing would happen. And if you throw out 50% of the company, it would just continue as is. So we actually see failure differently, and this is the way we actually also built Liquid Labs. We said, yes, we're going to fail, but it's not about failing. It's about trying things and trying as many things as possible to increase our chances of success. So the end game is to have as many successful innovations come out of Liquid Labs. The goal isn't failure, right? So we split it up.
And I think probably kind of an expansion on that is the first thing that we had to shut down, it literally took us probably about 2 months of conversations as to we're shutting this down. And effectively, we just went ahead and shut it down in the background. But then everybody around us at the corporate was going, oh my God, but we can't shut that down. We've already put time and energy and whatnot and into this thing. And we said, well, it's not performing. We're just shutting it down.
Let's have a conf call and discuss.
Well, it's just, PowerPoints and we have to have the analysis of and we're like, look, here's the KPIs. Here's the statistics. Day 1, day 14. Day 2, day 15. We can prove what's going on. Yeah, but there has to be a way to get around this. Well, put another 10 million into it.
Yeah, and John in our London office needs to know about this. When is John? Oh, John is in holidays. Okay, let's have a conf call in 2 weeks.
and the other thing too is, this conversation came up, I guess again earlier this year. They always ask the question, well, what does it actually take to wind this down? Like how would this work? And what are the actual shutting down costs for this project and everything? And we that question baffles me because we're so lean that from today to tomorrow we can almost shut anything down. We pull the plug and we say, okay, website goes offline, service, we return stuff to customers, whatever it ends up being, it's gone. And that's such a foreign concept to them. And they just, well, wait, but what are you going to do with the assets? Well, we're asset light. We don't really have anything other than software. If we want to reuse the software, we'll reuse the software on something else. But it's just that they just sometimes it takes 4 or 5 times going through the ringer on some of this stuff before then they realize, oh yeah, never mind. I don't need to ask that question.
I'm curious, how many people in the audience are actually working for corporations or large organizations? Or can you relate to what we're talking about? Yeah, raise the hand. Yeah, I mean, this is a problem that I think corporations are really, really slow, and as understanding what you guys are talking about is pretty much you are giving the opportunity to accelerate both the startups and the corporations. How do you do that? I mean, what is your secret sauce?
Well, on the one side, I would say that basically the two of us are connected to the right individuals that are decision makers throughout, let's say, the corporation. That helps, let's say, either pushing people to get stuff done, which we don't prefer to do. We work at kind of also grassroots level, that the operational people support whatever the product or whatever it is that we're bringing in. But you still need the people at the highest level to basically say, this is something that's really important to us as a group. If the people at the top don't sign off on that, then the people at the bottom are going to say, well, why should I invest the time in this if we've got other priorities? So being connected to all those different, let's say, layers helps out tremendously. So as an example, our anti-fraud platform, let's say I know startups that have worked with AutoDE in Germany that it took, let's say, approximately 2 years to get to the point where they could test what they were offering on the market, like get it, the little piece of JavaScript put on the website, and then start getting the data and everything like that. 2 years. When we walked in, we said, look, this is what we want to do. This is how we want to do it. The implementation is copy one line of JavaScript, put it into the website. This is how we want to do it. We walked in, talked to the decision makers, and within a couple of months, we were able to go live and actually start testing and basically get the product from we were nobody to then market leader in terms of data size within a couple of weeks. So it's that connection component of it to the actual decision makers, I think, really makes a difference. Whereas an external startup, when you go, yesterday I was in Frankfurt at the Deutsche Bahn, they were sitting there saying, oh, we're innovative and everything like that. And then 5 people in the audience went, yeah, so I've talked to about 30 different people so far, and each one of them has given me a different reason for why I can't do this project and whatnot, but they keep handing me over to the next person and hands me over to the next person, and nothing gets done, and I have no idea who to talk to.
Yeah, it very often, processes, team dynamics, culture. These are the elements that are pretty much very often work as a barrier in the corporations.
We also keep it separate, very specifically, and I think Michael mentioned this before, that every one of the businesses that we build, they're not being built to become dependent on the corporate. They have to actually, from day one, plan to be independent. So what we do is when the companies are spun out of Liquid Labs, they become subsidiaries of the corporate, but they're not pulled into business units. Or at least to date they haven't been, and we've actually kind of argued for that. Very importantly, because if we're launching a business and the people running it know that they have to generate their own returns, i.e. sell, and be able to survive without necessarily being propped up continually by the corporate, it also creates a mindset, a culture within that entity to just get stuff done. And vice versa, what we do is we facilitate a lot of the access without forcing them to spend the time. So when shit goes wrong, which it does all the time in startups, we're kind of, I don't want to say a Chinese wall, I would say we're more like the wailing wall, i.e. in the sense that we are the ones who go and talk to the corporate, and we take all the flack, but it never actually gets through to the startups kind of behind us. At the same time, when we need to have access to the right people, we know whom to talk to and who we can actually use to facilitate things actually happening. And that's, I think, also one of the kind of key success factors of what we do, is that we're allowed to maintain a lot of closeness to the corporate, which you would never have as a startup. But because of the way we've structured it, all the politics and kind of all the typical corporate bullshit happens. I mean, we're just realists. We know we're not going to be able to avoid it, but we can deflect it. And if you can deflect it, it allows the companies to grow far enough that they can then ultimately stand on their own 2 feet.
So wouldn't you say that, for example, a solution for different corporations will be to, for example, develop this sort of, let's call it innovation colonies, that, if the organization, the corporation is looking forward to develop more, innovation, instead of, asking their business units to come up with new innovative ideas, to actually create a new entity and treat it independently and give them some autonomy, with a hard word, give them some autonomy. So like this, there is this opportunity to have their own culture, their own dynamics, and they are not blocked by the whole corporate.
I mean, that's the core of what we do, right? So we basically said that by giving these businesses their autonomy, they can actually become businesses like every other startup becomes a business. I don't know if this works for every corporation. For the corporation to be able to do this, they need to let go. And I think that's actually one of the things that I think a lot of corporates screw up, is they don't realize that they have to let go for things to grow. And then there's a different type of a mindset. One of the other things that I said about how we started this business, we said, look, if the corporate has to go out and buy a business that's been venture funded and has grown and has successfully grown, has proven that something works, they might have to spend 20, 50, 100, 200 million to buy the business. If you look at what we do, we might ultimately in 5 years not even spend 10 million to build all these companies. And if only one of these companies is acquired by the corporate and it becomes a standalone business, you technically argue that our investor saved 190 million, not having to buy that company, but growing it in-house, right? So there's this fear on one hand of letting go and letting all these companies do these kind of startup things. But at the same time, often the corporate doesn't actually do the math. And they'll go out and buy something for 200 million, then have all the hassle of post-merger integration, which we all know is a nightmare. Once the lockups run out, your best employees all disappear. You spend a ton of money, and you're hoping that it works. Just look at Yahoo's acquisitions over the last couple of years. But if you look at kind of this approach, you could potentially lose all the money, and it's still peanuts compared to just one large acquisition.
Now, I have a question. How do you deal with, for example, the fact that, let's say you were a corporation, we developed this new entity that is, it operates as a startup, works as a startup, has the startup mentality, and all of a sudden becomes a really successful new business that technically could be even more valuable than the company itself. I remember Microsoft made an investment in developing a new company. The guy started it and actually became so successful that actually we become integrated afterwards, a part of Microsoft. But probably somewhere inside Microsoft, somebody was really upset about that, no? How do you deal with that?
I think someone was really upset at Microsoft when they invested in Apple, if you think about that.
Oh, yeah.
But Bill Gates made that decision on his own. And so I think that, back to the point of with a company becoming very successful, ultimately that's the goal, right? If we create something, I don't know how you want to measure the success. Is something that's worth 100 million or a billion a success? I mean, our investor is a large multi-billion entity. The fact that if we start something that becomes bigger, great. I don't think anyone's going to complain because they're going to own it anyway. I think the reality is a little bit different. I think the companies get to a certain size, and then the investor has to decide what they're going to do with it. Do they make it a part of the corporate? Do they leave it on its own? Ultimately, it's going to end up on its own and just be owned by the parent. I think also long-term, probably it's best to leave it on its own. And you can't forget, the larger the corporation, the more business units and kind of verticals they're in. So you can't necessarily just spin everything into the parent. A lot of times these companies stay independent, and they can grow as big as they need to grow.
Could you give us an example of yeah?
About the form of your business. Are you SPV, a dedicated vertical, or what is the form of business?
So Liquid Labs is just a subsidiary of the parent that's funded directly.
Yeah, and the question I wanted to ask, some concrete examples. Which one are the main corporation you're working with?
So things that we've done in the past.
Yeah.
So I would say the best example is the first company that we actually spun out of Liquid Labs. It used to be called Device Ident. Now it's called Risk Ident. It's a device fingerprinting business. So it's used to prevent fraud in the whole retail process. And what it does is the product itself, very simply put, it allows the retailer to recognize the customer or the user based upon their device. So if the device that you're logging into a retailer with has been used for fraud in the past, we'll recognize it. That's a very dumbed down kind of a description of what they do. But at the same time, the way we built that business is we were out looking in the market for what we thought were interesting areas to be building companies in. And at the same time, we were talking to our counterparts within the corporation about what the holes in their strategy were and what were they kind of looking to do. And we had found out that they were, at that time, actually building a short list of external third parties that were doing something similar, right? There's a fraud problem at every large retailer, and they obviously all want to reduce fraud because it just cuts into your margins. So what we basically did is we found out that they were looking for a solution to a problem, and we said, hey, we could potentially build something to solve your problem. but we don't want to force it down your throat. We don't want, you know, the board to come and say, you have to use this product from Liquid Labs. So we simply talked grassroots to the guys who were picking technology and said, we're going to build a product. We want you to compare us to all the third parties externally that you're looking at, and we want to compete. We want to prove to you that the product that we have is beneficial for you. And the only thing that we would ask is that if you actually choose to work with our product, we want you to be our first customer. So we want to make you our reference customer. And what we basically did is we built a product. Back to the large corporation problem. We built a new company faster than they were done doing their analysis of external third parties that they could work with. Right? So we were faster to build a whole company than they were to figure out who they wanted to give the contract to. So we had the business up and running in 2 months. 2-3 months. We had the software, kind of with the people, the team. And what we then were able to do is we technically won the deal. We implemented the software, so that became our first kind of pilot customer. That worked well enough that we were able to then go talk to other customers about this product that was piloted in-house. We were able to show real numbers, concrete examples of how that worked. And ultimately, we started basically then landing customers very quickly, large customers, well-known customers. And that company just got a ton of momentum. And that was a perfect example, perfect storm of how we work. We got a product off the ground very quickly and cheaply. We had our first customer at the corporate. We were able to use that corporate and leverage that relationship to get the first kind of initial customers externally. And then we were able to prove that the company could stand on its own 2 feet. It was on its way to profitability within the first year. And at that point, then we said, look, we've proven that the concept works. This is a business that has legs. It has the opportunity to be a large business down the road. And within the first year of actually having started Liquid Labs, we had already spun out the first company. So Device had then spun out almost 2 years ago. They're a standalone business owned 100% by our main entity, the Auto Group, and are very successful. They're 20, 25 people now. The additional funding to grow came from the Auto Group. So from our main investor ends up then acting at like the Series A investor. So they injected additional capital into the business, and now they're a solid Series A company, which probably won't need additional funding because they're going to be break even soon.
And one question: are you working across all Europe, or are you focused mainly in the German market?
All our businesses could potentially be global from day one, but we work locally in one office. We're actually quite adamant about having everyone sit together. We're also near to the corporate, but not on the same campus. So we made it very clear we want to be far enough away, but near. And our products can be, local or global. Most of them tend to be global from day one, but we tend to try and address the local problem if we can first, and just see whether it works, and then go global, kind of as the second step. But certain products are just global from day one. I think that's just a reality of the startup world, especially in Europe.
Anything you want to add?
I don't have anything else.
No. Okay. I have a question on it because before you mentioned about the VCs. The fact that VCs have the tendency to be, as you mentioned, their own worst enemy. What is your opinion about this approach of, okay, I don't want to generalize, but generally you could say that VCs have this approach that they look at startups like lottery tickets, right? They look at them, they buy 10, 5, and then let's hope that one of them works. In a way, it makes sense, and in a way, it's the right approach. As you mentioned, this is kind of the approach that you guys are taking. But from the point of view of the startup, what are the things that having access to money is not the solution? It's actually real doing something with that money that let's call smart money. What do you think about that approach?
So I think good VCs don't have the model of throw it out the wall and see what sticks. So I think the best, and I'm talking the tier 1 VCs, like the top 20 firms that are generating 80% of the venture capital returns worldwide. I think they are actually very systematically picking winners. Yes, there's a certain amount of investment risk, but they minimize those risks by being very near to their portfolio. And don't forget, kind of the reason the Valley works is not just because VCs are so smart, but they work really well together. And they're all kind of so intertwined with board seats and everything. So there's a lot more than just the company itself generating the success. It's the whole environment that the Valley has. I think bad VCs take that approach of let's start 10 companies and hope that one is standing after 5 years. I think that there's more of a benefit to starting a lot of things and seeing what works for corporates versus VCs. Because if you're just gambling as a VC, that's a house of cards. That's just it's gonna fall apart. And venture funds tend to have a long time, right? It's 10 years until you see which ones are bad. So I think that approach is used often, but is the wrong approach for venture capital. I think vice versa for corporates, not necessarily throwing the amounts that VCs do at a lot of the companies. So not saying, spend $1 billion on 10, 100 million bets, but let's say taking 10 or 20 million to start, potentially 10 or 20 little projects to see what works, makes sense. Yes, the teams have to also understand what they're getting into. So the reality of what we do is we tell everyone who joins the firm it almost sounds like we're so big. Everyone who joins Liquid Labs, literally is told you have 6 months to prove that you can make something work. And it's not even the people who are just running the projects, it's everyone on every team is kind of in this, I hate to call it up or out, but it's kind of value or not of value. And we tell everyone you have 6 months to prove that you're of value, either to the business that you're building or to us as Liquid Labs. It creates a sense of urgency. But we also tell people, look, if in those 6 months you're a rock star, but what you're working on fails, well, then we're just going to put you on the next project, right? We obviously do everything possible to keep people who are good on board. And we do everything possible to get the bad people out as quickly as possible. You have to be fairly brutal about it, right? The reality is that our companies, since we say they need to be able to stand on their own 2 feet as businesses, that doesn't mean that we can treat the employees like corporates do, i.e. that we coddle them and give them, a job for life. We have to make sure that we treat everyone at employee level just like we treat these businesses. It sounds almost brutal. It sounds very American, and oh my God, you shut things down quickly. But that's just a reality that leads to people kind of really working harder and making things work.
And I think there's a little bit of a, from the outside world, it can look very much as if, let's say, VCs are just kind of picking lottery tickets. But a good VC does, I think the key word is systematic. If they're going through, they're actually kind of looking at, okay, what do we have in the portfolio right now? Where do we want to put money? What do we, what's the actual calculated risk? So if they're calculating their actual risk on a, day-to-day basis as to where they stand right now, what's going on in the market, et cetera, then let's put it this way, as a startup company, you want their money primarily, or the fact that they sit somewhere where then they could sell you to Apple or something like that. But even if you go then to the extreme, so if you take like 500 startups where then they really literally try to have 500 startups in the portfolio, they're also very systematic about how they go about it. And if you listen to kind of the way that they present even that, with having as many things come through the door as possible, the way that, let's say, Dave likes to put it is, I can spend like 20 grand to find out how stupid you are, as opposed to putting like $1 million or 2 million on the table to find out how stupid you really are in, like, let's say 2 years from now. Yeah, or how stupid he was in thinking that was a good idea. You can argue whether or not the approach of having, let's say, that shotgun effect will work long term. Who knows? But they do have a systematic approach as to what they're going to do, and the ticket size being small enough to be able to kind of, they'll double down, triple down, 10x down on something that they see that ends up working.
Which, by the way, a small commercial, Marvin Liao, from a venture partner at 500 Startups, will be speaking here today. So if you want to go and check it out, highly recommend you to go and check out that talk. Fascinating stuff. I think that this is really, really cool solution. And before we go, I wanted to ask if anybody of you have any questions. Oh, yes. So I'll say very quickly, so for the microphone, first question is what is the need, and second, what is your methodology?
So there's 2 parts to what do we look at. The one is actually what's going on in the market. So the same, let's say, tactics or let's say strategy, let's say as a VC, I don't do this anymore, but I used to go through like 400 headlines a day to see what was going on in the world, see what was happening at a grassroots level. Yeah, and just to kind of get a feel, trend level stuff, and then kind of what's maybe the next wave. We don't necessarily have to be next wave cutting edge in terms of, let's say, a product or a service per se, because by the time a corporate becomes aware of, hey, I might need this product or service, it's already several years down the road, perhaps. But we're looking at to see what's going on in, let's say, the real world. The other side of that is then via the networks of all these daughter companies that the auto group has, being connected to all of them, we can literally just say, what's your strategy group saying is like the next big thing from your guys' perspective? And then at a layer below, let's say the strategic layer, whatnot, because we've been working at a grassroots level with some of the, let's say the fraud departments, whatnot, we can also ask those people, what do you see as a particular need? And so that's we try to kind of cover both sides. What do they see, and not be blinded by, hey, what do they see, but also to take a perspective of what's actually going on in the market. And is there an opportunity, like the device fingerprinting thing? Yeah, they had the need, but the opportunity came from looking at what was going on in the real market. And the actual assets we could leverage were the retailers on the auto group side, and that was how we kind of came across that opportunity.
Just to continue answering the first question, we're also very much the trend scouts, but not in the sense of like business development or strategy group of a large corporate tends to go out and talk to like analysts, and they go to events and listen and take a lot of notes. Like part of a strategy group. What we actually do is, because of our VC background, so we're actually talking to the VCs. We're looking at what are they investing in, and not necessarily kind of to copycat it, because like Michael said, if we're cutting edge, we're probably not in the right place for a corporate. So we're looking at things that have gotten past the initial kind of seed Series A phase, what works, and how could we potentially use that to plug the hole at basically our corporate, right? And that's why we're also very focused just on one versus offering the service to multiple corporations, because we very clearly kind of know what the holes are, talking to people. And then when you go out and talk to the VCs what they're investing, you could say, oh, wait, I remember that someone said, you know, that's a problem they have, and this would be a perfect solution for it. And maybe we can create a hybrid model of, you know, we see 2 or 3 companies that are similar. We can come up with an idea of our own company to build to plug that hole. And then I'll just go and answer that second question. How do we actually plug the hole? By building the business, we actually create the software and the technology. It's always a software or technology hole that we're plugging, right? That's the approach. I mean, we're not focused on certain parts of the business. I mean, if the trucks aren't working, we're not going to go figure out how to, get new trucks for our logistics business. But we're looking at solutions that are, or problems that can be solved with software or technology, and we'll just build it. So we're plugging the hole by just building it ourselves.
All right. There was a second question in the back. No, it's all right. Anybody else? It's free. All right. Well, before we go to because we have lunch right now, right? Oh, hungry. First of all, I want to thank you very much. It was very, very interesting. And before we go, can you share with us where can we find more information about you and about what you guys are doing?
Just go to Liquid Labs website or Google either of us. Yeah, it's liquidlabs.de, one word. Our name's on the schedule. Google us.
liquidlabs.de. Thank you very much, everybody. Have a great day and see you around.